Most investors live in a state of constant uncertainty, trying to gauge if today's market is a safe harbor or a cliff edge. You stand on the precipice, waiting for the one signal that tells you when it's safe to jump in. This anxiety fuels the popular concept of the risk-on, risk-off toggle. It suggests you can treat your portfolio like a light switch, flipping to aggressive assets when the outlook is sunny, and clicking back to the safety of cash the moment cloud. This mental model relies on the academic definition of risk, historical volatility. In this view, an asset is risky if its price fluctuates rapidly, and safe if its price remains stable over time. Howard Marks argues that this reliance on volatility is a mistake. He views price swings as a mere symptom, a quantifiable number that fails to capture the actual danger to an investor's capital. Real risk is the hidden, unquantifiable probability of suffering a permanent loss. It isn't a line on a chart. It's the chance that your money never comes back. The standard textbook graph on the left suggests that taking more risk leads to higher returns in a straight line. But the reality is the bell curve on the right. Pursuing higher returns simply widens the range of possibilities, making the outcomes less certain and the extremes more severe. This left-hand tail represents the catastrophic events, the unlikely but possible disasters that can wipe out a lifetime of savings. A temporary drop in price is a momentary discomfort. Suffering a deep negative outcome that results in a structural loss is a failure that permanently derails your wealth-building timeline. Investors often approach the market with an American football mindset. They assume they can field an aggressive offense to score during bull markets, and then swap in a defensive unit to protect their lead during downturns. This leads to investors sitting on the sidelines, waiting for a market stoppage or a clear referee's whistle to move their assets into cash. Financial markets lack quarters, timeouts, or officials to pause the action. There is no scheduled break to allow you to adjust your strategy before the environment shifts. Without a whistle to signal the turn, most market timers end up panicking. They sell their holdings in the heat of a crash, locking in their losses at the absolute bottom. Sitting in cash during the subsequent recovery is the cardinal sin of investing. By the time the all-clear signal feels obvious, the most significant gains have already passed you by. Downward price fluctuations are temporary hurdles. If you maintain your position, the market's recovery eventually carries you past your original cost to new highs. Attempting to time your defenses perfectly ensures you miss the long-term returns required to build wealth. Global football, soccer, offers a more accurate model for the markets. The game moves fluidly, without the artificial stops of the American version. The same 11 players must stay on the pitch, playing offense and defense simultaneously. They must react to the flow of the game, without waiting for a coach to change lineups. This continuous participation requires a portfolio built for asymmetry, a strategy that reacts differently to gains than it does to losses. Most managers produce symmetrical results. Aggressive managers gain 20% in up markets and lose 20% in downturns. Defensive managers gain 5% and lose 5%. But an asymmetric manager captures the market's 10% gain while mathematically resisting the decline, losing only 5%. This requires a psychological compromise. To protect your downside, you have to accept that you will rarely beat a raging bull market during periods of extreme euphoria. Continuous built-in defense prevents the urge to panic. Because the portfolio holds its value better during the drops, the investor stays calm and keeps their capital working. Surviving the inevitable crashes is far more critical to long-term compounding than maximizing gains during market highs. Building an asymmetric portfolio requires the mindset of a life insurance actuary. Life insurance companies guarantee payouts on mortality, a risk that is a mathematical certainty. Every person they insure will eventually die. They manage this through 3 pillars: absolute awareness of the risk, deep fundamental analysis of the individual, and broad diversification across policies. They demand a risk premium, a price that is high enough to compensate them for the known probability of a payout. This chart maps asset quality against purchase price. We assume buying high-quality companies is safe, but high quality combined with high price creates a danger zone, leaving no room for error. Conversely, the bottom left quadrant, low quality at a low price, often offers mathematical protection. Buying an out-of-favor asset at a steep discount creates a mathematical floor. When expectations are already zero, the potential for further loss is strictly limited. The discipline of the price you pay provides more safety than the perceived quality of the underlying asset. Every investor must eventually align their strategy with the amount of analytical effort they are willing to provide. This matrix shows how different identities navigate the markets. The passive indexer puts in low effort and accepts total market risk. They succeed simply by refusing to sell at the bottom, allowing time to heal any temporary declines. The danger zone is occupied by high-effort investors using the American football strategy. They burn energy trying to time the switch, usually resulting in selling low and buying high. The asymmetric actuary uses high effort to price risk accurately. They build portfolios designed to participate in the gains while structurally resisting the losses. Market risk is counterintuitive. Periods of prosperity and rising prices breed carelessness. The system becomes most vulnerable when the consensus believes risk has disappeared. An asset becomes riskier as its price rises, and the crowd grows more optimistic. It becomes safer as its price crashes and the crowd flees. Risk is a continuous underlying condition. Success requires pricing and managing it, rather than attempting to avoid it or switch it off.